investors?
Exactly. Well, first let's define liquidity. And we're talking about alternative strategies available in liquid structures like mutual funds, ETFs, ETNs, and exchange-traded products. So liquidity is the first dimension. The second dimension is alternative, which includes alternative strategies and alternative assets. Alternative strategies represent the democratization of hedge funds. Long-short, risk management in easy-to-use, liquid, low-cost vehicles. Alternative assets represent things that are not stocks, bonds, or cash, like commodities or currencies. So those are liquid alternatives.
So it sounds a lot easier when you define it that way. Is it something that investors can easily get into, especially after a year where we had this huge run-up in stocks? Is it too risky for the average investor if they can just stick their money in equities?
Well, it's interesting. People need to remember that equities are risky, and we've had lots of volatility and lots of drawdowns, and both of those phenomena will return. So if it's about risk management, there's a whole spectrum of liquid alternatives which are designed to reduce volatility, reduce drawdowns, and provide a smoother ride over time. So liquid alts are actually an interesting complement to the growth-oriented part of an investor's portfolio.
In general, what sort of percentage should the average investor have when it comes to alternatives if you have a traditional stocks, bonds, cash?
Sure. Well, we've been talking to advisors all around the country whose job is to provide a professional perspective in portfolio construction. And we see a range of use of liquid alternatives from 10 to 25% as a complement to the traditional stocks, bonds, cash allocation. And that's a significant amount. It's enough to be able to diversify the portfolio, and it's just the right measured amount in the 10 to 25% area.